Here we are. All right. Hi, everybody. I'm Dave Davick, and my partner here, Crystal.
Hello.
Propeller. Yeah, we're excited to spend the next hour with you. Quick background on us. I'm a CFO with Propeller. I'm also the co-lead of our transaction advisory team. Happy to tell you more about either of those as a follow-up. Crystal, go ahead, and you want to give you a little bit of background on yourself as well?
Yeah, so I'm a VP at the firm, but I also oversee our accounting team. So big old accounting nerd right here. Anybody who wants to talk debits and credits, I'm happy to discuss it, although I'm sure you won't want to. But yeah, I've been working at Propeller for about 4 years. I'm a diehard Propeller fan and honestly just love working with startup companies and helping you guys do your thing.
We'll keep this pretty informal. I'll tell you a little bit more about my own background in Propeller as well, but we are recording. We'll send out the slides as a follow-up, and Carol, by all means, jump in if you want to say a couple words about Branchfood here before we rip into the Propeller prepared slides.
Yes, thank you, Dave and Crystal, for introducing yourselves. Welcome everyone to this financing and accounting strategies for food startup success. Just a quick overview of Branchfood and what we do. We are the visionary community of food innovators anchored in Boston with a global reach. Since 2015, we've been catalyzing the connections among food founders, experts, and industry leaders, accelerating the key partnerships that will transform the food industry. So if you're a founder looking for personalized support, expert guidance, mentorship services, do check out our membership. If you're an early stage company, a food or beverage company, or even agri-food tech company, and you're currently fundraising, take a look at our sister company, Branch Venture Group, which is a network of angel investors that support food ventures through network capital and expertise. You can learn more at www.branchfood.com and check out our upcoming events to stay tuned. I do want to say thank you to Propeller Industries for collaborating with us on this educational session. I'll give it back to David and Crystal to share more about Propeller and what they do, and then to dive deep into the topic. It's a very important topic for early stage companies, and I hope that you'll all acquire best practices on how to gauge the financial health of your business and take it to the next level. Just one kind request, please keep yourself on mute until we transition to the questions, just to enable a better experience for everyone, and enjoy it.
Awesome. Thanks, Carol. I mentioned we'll keep this pretty informal. And so in the past, depending on how many people we've had on these webinars, we've sort of said, ask questions as you have them. So maybe in the interest of just keeping things moving a little bit, drop them into the chat box. But by all means, if you have an urgent question and we're not getting to you, feel free to interject. As I have on the slide here, there's a decent chance, given that we're on Zoom, somebody's going to interrupt. So, informal, this is your time. We've got a handful of prepared slides. We'll go through those, but by all means, help direct us as to what's most helpful to all of you. So I mentioned I'm a CFO with Propeller. I'll segue a little bit into what we do both on our core business as well as a handful of other specialty areas that we have. I've been with Propeller 5 or 6 years as a CFO with a portfolio of clients. And at Root, what we're doing is everything that you'd expect from the CFO and finance function at a larger company or later stage company, but geared towards early stage businesses. And it's fractional, meaning that you get as much of whichever element of that as you need, depending on the stage of the business. So we also have other groups that I mentioned, the transaction advisory team, where we're helping a subset of our clients that need help with things like fundraising or navigating an M&A event. Crystal leads our accounting function. As a complement to that, we also have a specialty tax and compliance area. We don't do taxes, but we have a number of partner CPA firm partners that we work closely with. So if you're a company that's going through, for example, a quality of earnings and you need some help navigating that, we can probably help. as well as some other areas there. 300 or so active clients. We have, maybe a little bit outdated, but 260 or so full-time professionals. About half of those are here in the States. We have offshore teams as well. Pre-pandemic, we had 6 physical offices. Today, we have about 260 offices around the world. So across a number of different specialty areas. Industry-wise, CPG, and I think this audience is very much one of our 2 primary industry areas. So about half of our clients, give or take, are CPG and or direct to consumer. The other big area is tech, broadly defined. And there's obviously a number of sort of hybrids of both of those, as well as some other areas that you can see here on the slide. Little promo for some of our alumni and current clients. You probably recognize some names. In terms of the group on this call, we saw quite a few great early stage founders and groups that are just starting to build your business. So I think we're skewed a little bit more towards early stage businesses, although there are, sounds like, some attendees that are also providers like partners like Propeller and some of our CPA firms and others that we see, as well as a handful of later stage companies. So if you have a question over the course of the presentation, I guarantee you somebody else in the group does too. It's a really diverse attendee list. So by all means,
Yes.
I think, Crystal, it's time for our first
Poll, yes. So we're going to launch a poll. We have a couple of questions to ask everyone to kind of get a good feel for who's in the audience, and it can kind of help us basically set up what questions you might ask. So we'll give you about a minute or 2 to respond.
Can you see, Crystal, when I'm filling this out, or am I a wild card for you?
You are a wild card.
Cool. Great.
And we're about 30% participation. So a few more coming in. I'll give this a few more seconds. Also looks like we have more people joining us. So welcome to those who just joined. And we're going to be ending the poll. And so it looks like the majority of our participants, this is your first startup. So welcome to the wild world of entrepreneurship. For the majority of you, you are the CEO, although not uncommon that also a third of you are everything for the company, including the janitor, bookkeeper, receptionist. See the third question, which was past interactions with accounting and finance. Oh, that makes my heart so happy. You love spreadsheets and numbers. So you're really going to love this conversation. Number 4, which is, so most of you would prefer to be a public speaker over a shark diver. Very interesting. Well, I'll hand it back to you, Dave.
Yeah, I think the split of roughly 2/3 of you being first-time founders or entrepreneurs. I'm curious, within our own, this is anecdotal, but I think that roughly matches what we see with our client base. We see for sure some entrepreneurs have done this multiple times, but often we're working with companies where it's their first go round. So I think that's probably a good segue into how we view financials. And I'll put this in the framework that we're going to use to structure the conversation is really around the 3 questions that a good set of financials are intended to answer. So one set of questions is, if I'm an entrepreneur, where can I get money? And we'll talk about that a little. We have a bunch of slides in an appendix, but we can talk through some of those if it's helpful for the audience. But at least initially, we'll focus primarily on the second 2 questions, which are how should or did I spend my money? So should I spend it on growth, things like sales and marketing, people, headcount, those sort of costs, processes, systems, technology? And then based on those and the results I have, how do I explain it? And that varies depending on who your audience is. We'll talk a little bit about how you get yourself buttoned up to talk to investors, whether you're fundraising or you're talking to your board as you get down the road. And the overlay for that structure is where you are in your growth phase. And so use three main buckets here: startup, which I think is relevant to most of you, which is, hey, we're early. It's, you know, the team, to the extent there is a team, maybe it's just yourself and you're doing everything. Maybe you've got a co-founder or a, you know, 3 or 4 person team. In the early days, that's what those are all the resources you can afford. And as you grow, that team obviously evolves to where you can start in the growth phase, building out some specialty areas. And maybe down the road, that even means finance and accounting, but often it means operations or R&D or sales and marketing. And obviously, as you get to maturity and exit, that team evolves. Hopefully it's not growing quite as quickly as the company is, right? You should get some leverage there, but you've got the ability to have specialty areas. Likewise, your corporate structure may also evolve lots, and we can talk about that if it's relevant. Probably follow-up questions. I often get, there's a handful of questions we'll get around, hey, I'm an LLC and can I fundraise with that? Let's take those offline because they get pretty specific, but your corporate structure will often change, as well as your go-to-market. Usually in the early days, you might have a product, maybe you've sort of figured out product market fit, but often you're still in the R&D phase. But as you get into that growth phase, usually you have multiple products, hopefully a menu of items. You've also migrated out of, maybe you started as direct to consumer only, and you're migrating into multiple channels. And so the needs along those, as well as what your financials will show and the resources you need to fund that business, will evolve as well. I'll tee this up and then maybe Crystal, you can talk through some of what we see. We often start working with companies in the really early days, and it's not quite the proverbial shoebox of receipts that they're handing us, but it kind of is sometimes, where there's just it's just kind of a mess. And hey, help us put some structure to this that's appropriate for the stage that we can afford, but also helps put in some building blocks that we can use as we grow. And so here are some of the tools that you may want to think about at each of the various stages. And Crystal, if you want to jump in and talk through what we see most typically.
Yeah, and one thing I would stress with these tools is the biggest thing that most, new founders lack is time. Like, you are out trying to figure out, are you going to do a co-packing model? Do you need to go find a manufacturer? Are you creating it yourself? What does the marketing look like? And because of that, because there's so many questions that you have, it's important to find tools that give you back time. And so that's where we stress, finding some tools. And so QuickBooks is usually what we see with a lot of our early stage companies as, their accounting tool. It's usually not until companies get to around 30 million in our growth stage that they might switch to, say, a NetSuite. But overall, QBO is typically what we see and is perfectly sufficient. And it has a ton of attributes inside of it that will help make the work easier for you. The other thing we like to say is to use Bill.com. It's a great tool for paying bills, essentially, and doing all of your AP functions. This basically replaces you going to the post office, you calling the bank. You can just go into the portal and get all of your bills paid and have all of them go directly here. And it also, sends out emails to your vendors to let them know when they're getting paid and when to expect payment. In addition to that, credit cards, this is a big one. This is, as Dave said, more often than not in, the old school world of accounting, you would end up with a shoebox full of a bunch of receipts, and those receipts were usually unreadable. So now we have great expense platforms. Expensify is, mentioned below. Brex is also one that helps people. There's Tally, there is Zoho now. So there's a number of expense platforms out there that can support making sure that you're getting expense reports and making sure that you're capturing all of your OpEx expenses. And then PEO or payroll providers, we like to mention Gusto, JustWorks, and TriNet. Gusto and JustWorks are usually the two we see the most. Both of them also offer health benefits. So if you want, if your team is growing and you want to be able to offer them health benefits, you can do that through Gusto or JustWorks. The difference being that Gusto is just a payroll provider, but with JustWorks, it is a PEO. And so in that way, you are also, or your team is also an employee of JustWorks. And then outside of that, in Series A, it does mention an inventory management system. I do want to bring that up since most of you are in the food and bev space. There's some expensive IMS systems out there, but there's also some really good ones that can help you get started from the get-go, like SOS Inventory. It's relatively cost-effective, but is also a great way to make sure that you're capturing those COGS, and it'll connect to your QuickBooks account. So that way it makes sure your invoicing is coming over and that it's capturing all of that information, so that way you can do your financials. So again, definitely want you to think about the tools that you're using, talk to the sales representatives, and see if these are things that can help you save time and how you can set them up to give you back that time to make sure you have the time you need to go meet with investors, sell your product, and do all of the relationship building that comes with this business.
Yeah. In addition to finding tools that help save you time and take things off your plate, the other thing I would add, just philosophically, is to keep it easy, keep it simple. Often I'll hear early stage companies that say, "Hey, I got a great offer from such and such tool," and it turns out that that tool puts you into something that's really customized in a way that might be great, but people, investors, others have no idea what this is. So just as a general bias in the early days, keep it simple. Keep it common in the structure that you have, unless there's a really compelling reason to have something that is uncommon, and make it easy on yourself, basically. Okay.
Actually,
Sorry, I
Sure.
just want to interject. There's someone asking about the IMO solution that you mentioned.
IMS. I think you mean inventory management system.
Exactly.
Yeah, I think Crystal mentioned SOS, and there's a whole series of, I guess there's a couple of categorizations. There's plugins to QuickBooks Online, like SOS, like Sin7. There's a whole bunch, and they have pros and cons that change and evolve over time. So it's worth having a conversation if you're contemplating one of those with. Propeller can obviously help you on that. There's others that can help you too. There are other category of systems like an ERP, like a NetSuite, that tend to be a bigger commitment. And so they can be the right solution depending on your growth plans and complexity. Often in the early days, what's easiest and makes the most sense is to if you've got QuickBooks Online, is to include a plugin. And I don't know, Crystal, if you want to add any color around sort of the benefits.
Yeah, absolutely. So QuickBooks does, like Dave mentioned, have that plugin of SOS Inventory. It also has its own inventory feature, which is only useful if you're a turnkey product. So if you're buying a product from a co-packer and it's including all of your materials, and you don't have to buy like the tomatoes or, the mustard seed that goes into the condiments that you're making, then you can absolutely use QuickBooks only and not layer in that inventory system. But once you kind of layer in that inventory system, it's because your product is getting more complex. It's because you're taking over more of that supply chain. And so that's when you might consider something like, again, SOS Inventory or Deer. It also depends, honestly, of whether or not you have more sales going direct to consumer or if you're selling more through wholesale. So that becomes like another layer in which you want to take it into consideration. And we're happy to have some of those conversations with you guys if y'all want to like shoot us over an email.
There's a question in the chat about Peachtree specifically. I don't have the answer on which of those things can work with the various systems. Again, that sort of that menu of which systems complement which GLs changes all the time. And likewise, recommendation for zero. Probably best to have those individual conversations as follow-ups, but I will just say probably 80% of the companies we see are on some form of QuickBooks, mostly QuickBooks Online, and most of those who go down the path in the early days of an inventory management system end up choosing a plugin like an SOS or some of the other names. But there are a bunch of other permutations, and they might make sense. But I think that's what we see most commonly.
Yes. And also, we'll use this moment to launch a quick poll. Perhaps.
Great.
Okay. It's one question, super quick. And here we go. Because we're about to talk about financial statements and how you tell your story. So this will help us get a good guide as to how you feel. We're about halfway there.
You got him, Crystal? Sorry, go ahead.
Yeah, we're 63% of the way there.
Yeah.
So I'll give it a few more seconds.
Yep. Well, we're waiting for the final tally. Just I mentioned at the outset, there's sort of three main questions. The first one being, how do I fund my business? The second two is where I think we'll focus on as we go through, and based on the poll results, we'll figure out whether it's 101 or 201 that we do. But again, we'll send out these slides and happy to follow up if you have more specific questions. But the primary focus when we go through financials is kind of twofold. One is, how can I use these to better understand the operations of my business? How am I doing? Usually in the early days, it's how much is this costing me? How much runway do I have? How much more time do I have before I need to go out and ask for money from others again? And what are some of the drivers of that? And then based on that, along with your plan, how do you articulate your story externally to make it as easy as possible to finance your business? Wow, okay, almost half of you are P&L ninjas, cool. And then about a third have at least some familiarity, but it could use a little, probably have some questions, and then and you really don't want to do this. And that's why maybe a partner like Propeller could be helpful. Yeah, okay. Given that a lot of you have at least some foundation, we won't dwell on these, but again, chime in with questions. I think that'll be most valuable. There's a slide, a little bit of a catch-all slide around what do investors look at, what do they focus on when they're reviewing financial statements. A lot of this is industry specific, and it can get pretty granular even within food and beverage, depending on which channel. You know, if you're a e-commerce only, your metrics and KPIs, key performance indicators, are going to be different than somebody who is wholesale only. Increasingly, we see multi-channel, including retail businesses, so maybe all of those are relevant. But clearly revenue, both today's revenue and your growth rate are really important, and often in the early days, those are the primary drivers of valuation. You're often valued as a multiple of revenue. Gross margin is the other component. Basically, the higher your margin and the higher your growth rate, the better your valuation. But obviously, there's a whole spectrum of outcomes. There can be reasons why that's not the case. Your unit economics and profitability metrics also important. There's a whole slew of metrics around marketing and customer effectiveness. So things like, repeat purchase rates. If you've got a subscription component of your business, how often are they repurchasing? What's their average order value? All of those things. So it's important in the early days, particularly when you're developing your financial model, to understand what are your revenue drivers, and usually we'll start with that. Like, what are your KPIs? Because often your board, your investors, those are the questions you're going to get. So if you start with those in mind and build out your model, it can help you structure it in a way where you're prioritizing those most important things. And also, you want to understand the resources that you're going to need. So what we do, and often it's the first time that companies have seen this. When we're working with companies, we pretty quickly put in place a full 3-statement financial model. So your P&L, your income statement, but also your balance sheet and cash flow. If you really want to understand how much cash am I using and why, and how much runway do I have and why, you need to look at not only your P&L, but also your balance sheet and cash flow. High level, we talked about sort of the phases of growth. I think this is also an important overlay to some of those metrics, is how those evolve and sort of what you're shooting for across those. And I don't know, Crystal, if you want to jump in on this slide, but we talked a little bit about revenue. You've seen a lot of these companies, Crystal, as well. So would love your voiceover on some of this.
Yeah, I think the big thing that I would point out from this is, at the end of the day, they want to see that your product is growing, right? That your sales are increasing over time, that your gross margin is consistent and increasing over time, that there's a path towards exceeding what the category average is. And when you think about that, it's like how, if you're making a protein bar, how is this protein bar doing in comparison to other protein bars? And so those are different things, that, like different metrics and kind of like basically story points that you want to give to your investors and to anyone asking questions about your financials who's interested in coming in, because it'll help you basically get them to invest. They want to know that your business is going somewhere, right? We also talk about velocity. So is this product line shrinking or is it growing? As a customer base within the nation, is it growing, right? Like where are the trends from a big picture standpoint in relation to the product that you're launching? And then the other thing I might add is your team, which is you. Like more often than not, the investors are also investing in you. Like that is a big part of why they will choose to invest. And so if you've got industry experience, it's worth highlighting with them absolutely what your experience is, where your tenure is. If you've worked, 15 years at Anheuser-Busch and then you go launch an alcohol product, those 15 years are valid to investors, and they'll know, your experience also is behind this. So that track record also comes into how you tell your story to investors.
Yeah. And just as a little anecdote on gross margins as an example, I mean, often there's a progression of your financial metrics, and part of your role as a founder and also having a good finance partner is being able to articulate what that progression is going to look like and then delivering on that. We helped a client of ours with a fundraise probably 2 or 3 years ago now, beverage company that had their own manufacturing facility. And at the time, their gross margins were in the 20%, which for those of you who are in that business, 20% gross margins, not great. It's a bit of a red flag for an investor saying, ooh, I don't know if that's an investable business with 20% margins. They had a friends and family round that bought them some time. But the story that we were able to articulate and they were able to deliver on was, look, it's 20% because we've got this big production facility. We anticipate that as our wholesale footprint grows and our volume grows, here's how that's going to impact our financials. And we basically built a bridge of, hey, 20% gross margins today is going to go to 30 to 40 to 50. And they were able to execute against that over the next 12 months. And actually, when their gross margins hit what we thought they would in the 50+% range, we went out again. It was a very different investor reception, as you might imagine. They were able to fundraise successfully, great partner. But a big part of it was really being able to map out what should this look like if we execute against it, and why is it 20%? Well, it's not because there's a fundamental issue with our product. It's because of the investments we've made.
Yeah, and the only thing I might add there, since for most of you it's your first startup, is what is a healthy gross margin? So most of you will want to try and hit 30% or higher. Anything below 30% will come off as a red flag. And as Dave mentioned, like you need to find a path also to increase it from 30% and greater. The other thing is like the majority of the financials that we see honestly coming into the firm, our clients typically have very inconsistent gross margins. If you look at their gross margin month over month. And so that's one of the quickest ways for us to kind of create impact in their story is how can we make this more consistent? Because that translates into whether or not you have a good line of sight into what's going on in your business and you're able to adjust things to create that consistency.
So for those of you on the poll who would, avoid this like broccoli as a kid, let me give you a little bit of the 101 on what each of the financial statements, and this is probably a reminder for those of you who are more familiar with this. Most of you, if you have any sort of financial statement experience, it's with the P&L or the income statement. As a reminder, the income statement tells you what happened over a period of time. And that's where you're going to find a lot of what we were just talking about, gross margin. So gross margin or gross profit. Gross profit is the dollars, gross margin is the percentage. You'll hear those terms interchangeably, but that's actually what they are. All that is your revenue or your sales, less the cost of those sales. So we won't get into all the different permutations of what goes into cost of sales, but it basically, but most of it is often your product cost and anything around sort of delivering or manufacturing whatever it is that left the warehouse. Below the line, below gross profit, you have operating expenses. So that's the costs to run the company for that period. So things like the cost of your inventory or the cost of the $20,000 or $30,000 truck that you have, those are assets. Those are going to go on the balance sheet. They're not going through operating expenses. Revenue minus cost of sales minus your operating expenses gives you your income or loss for the period. That's the super high level version. There's obviously a lot of detail underneath that, some specifics. I'll flip over to the balance sheet because I find that balance sheet and ultimately cash flow are where people are less comfortable usually. Balance sheet, so it's a snapshot. So unlike the income statement that measures what happened over a period of time, balance sheet is as of a point in time. Assets, that's what you own. So cash, obviously, but also inventory, your accounts receivable, anything you're expecting to get from customers, and any fixed assets. Liabilities are things you owe. So most typically you'll be familiar with credit card, accounts payable, to the extent you have any loans. And then equity is how you funded the business. So to the extent that you or other founders have put money into the business, it's also where the difference between assets and liabilities, basically your profits and loss go there, right? In each period, your balance sheet should balance, right? So assets minus liabilities equals your owner's equity. Why is that important? Well, remember, one of the key questions is how much cash am I using over a period of time? And that's really the interplay of those two financial statements. So start with an amount of cash at the beginning of a period. The change in those balance sheet accounts, that's the change in your assets, the change in your liabilities, plus or minus any financing or payments made. That's your net cash flow over a period of time. And that'll answer the question of, hey, how did I generate cash? Am I burning cash, and how much? Okay, so that's the flyby on financials. I'm sure people have questions on that. So let me just pause here if it's helpful to go through any of this. Otherwise, we'll talk a little bit more about how to get buttoned up.
We can also run our last poll, which will kind of help us get a good gauge on what you want to talk about next. So I'll go ahead and launch that while some of the questions come in.
While Crystal is launching or going through the poll, feel free to drop your questions in the chat, or to just raise your hand and unmute yourself and ask the question live, whatever you're more comfortable with. If you raise your hand, one of us will call your name and ask you to unmute yourself and ask the question directly.
Love the question about slotting. It's interesting. Slotting is one of those, a lot of people love to put in operations expenses, but slotting actually is something that should be up in your cost of sales. It affects your gross margin at the end of the day. And so what, accounting speak, it would be in a contra revenue account that's reducing your gross sales.
Yeah, and it's one of a whole bunch of things that go under the bucket of trade spend. So for those of you who are in the wholesale channel, you, I'm sure, have a ton of experience with various forms of trade spend. For those who aren't, it might be a bit of a foreign language, but it's a whole wide spectrum of what we see in trade spend, but it can be as much as, I don't know, 15 to 20% of your gross revenue. But again, there's sort of a wide range of how much you'll spend, whether that's in any of its various forms. What's an EE agreement? I don't know where that was on the slide. Was that an employee agreement? Yeah.
It's in the category.
Let me find that. I'll find that as a follow-up and shoot you a note. I'm not sure which, but I think that was just it probably had to do with hiring employees. I don't know, Crystal, I missed that one.
Yeah, so it looks like they're
employment agreements, I think,
yes.
Yeah.
Employee agreements. So the majority of the time you'll see these, especially when you're bringing in high profile roles, like a VP of sales, for instance. Those are situations in which you'll have essentially documentation that tells you, what is their compensation going to be, agreeing to, a bonus structure, and also stock compensation, which sometimes comes in as your business gets a little bit bigger. So that's when you'll want to have those employee agreements. Usually we don't see a lot of them within like very early stage, but something, again, to make sure that you consider as you get bigger and hire those bigger titles.
Yeah, it'll come up in diligence if you go out to do a fundraising round. They'll want to know if you've had any key hires, if there's for yourself or other key members of the team, they'll want to understand what that looks like. So sorry, I thought that was from the earlier stuff. Contra revenue, all that means is it reduces revenue, and we can so we can get into the specifics as a follow-up, but it's just it's a direct reduction of revenue rather than an expense. Okay.
Dave, sorry to interject. Irene in the audience has a question to ask. Go ahead, Irene.
Yeah. Hi, guys. Thanks for putting this on with Branchfood. For those of us who are super early, can you quickly talk about wholesale best practices in regards to the financing? What are some of the pitfalls that we should be looking out for? And then in regards to gross margins, what is that standard still in wholesales? It's a different beast altogether versus going B2C. So can you guys give us some feedback or suggestions or tidbits around that? Mainly because this presentation is very high level and it's a little bit more advanced, at least for me, because I'm nowhere near putting together a cap table or having an EE agreement, or I'm just getting my intellectual property documents finalized at this point and creating a vendor agreement.
Yeah. Maybe I'll start with where you ended, Irene, and then Crystal, by all means, jump in and we can address any specifics on wholesale. But we've got a slide back in. This might be a helpful one. In terms of funding cycle, a lot of the companies that we work with tend to be, so I'd say the median is around a Series A. So they're at that point where they are ready to do a price round. There's obviously a really sizable bell curve. And so if you're in the really early days, find like, what do you actually need to get financing from friends and family? Differs dramatically. It's not much, right? It's you. So in the early days, often you're either self-funding or you've got somebody who really believes in you or the product or what you're doing that's going to help you with some funding, right? So a lot of the diligence items really have to do more with a series, like a priced equity round, Series A, Series B. So on your question, Irene, around wholesale and really how to get started, if I'm saying that back to you, right? Tell me more about your question. Was it specific to financials or more about how to just get some traction in wholesale channel?
It's specifically around wholesaling, right? I know somebody mentioned slotting, and I'm eventually going to have to deal with that. But if for any of us who are really, really early, and this is why I'm saying that, you know, your presentation is too high level for us because we're nowhere near. Yeah, we're still working on our proof of concepts because the majority, if anybody here is in CPG, you spend about 1.5 to 2 years in R&D, right? So any recommendations on best practices, I guess, yeah, you can actually tackle it from the funding perspective because we eventually have to find money. And then also just the wholesale angle, because that's what I'm doing.
Yeah, and curious to open it up to the broader community here, because I'm sure people have a perspective. I'll tell you what we see. There's a few different paths that we see. Sometimes we see founders who are really sort of bootstrapping, and in the early days, they're building out awareness, door by door or distro point by distro point, and that might be as granular as farmers markets and local stores, and then you get a little bit bigger, and then at some point you're big enough to have meetings with UNFI or okay, you're a distributor and you want to go either regionally, like that. That's a trajectory that we often see. It's the other extreme is you've got a concept, and a lot of the plant-based meat alternatives I've seen sort of skip over all of those steps, right? And you've got something that's really unique and interesting, and even if it's just conceptual at this point, you might get an investor who gets really excited about the market opportunity and what you're building, and you skip over all those steps and they take you in almost immediately to just a different set of distro points. I suspect for many of you, though, it's more the former path of you've got to build it, and it's you just got to get your product out into market and start building that much more organically. Crystal or others, by all means, jump in if you've got firsthand experience and want to talk through anything you've seen. Nope.
Hi. All I
Anything
can do
to add,
is like
so.
agree with your sentiment.
I can,
Oh, go for it, Becca.
yeah, I can weigh in on this. I mean, so I'm Becca Booth. I own an almond butter company named Beck's Bang and Butter. And we have a delicious, very niche product that is quite popular right now. Like a popular health food, I guess. And I mean, I hate to be like the bearer of like difficult news, but we're 6 years old and we are just now signing on with our first distributor, and we start, and again, I'm working full time still. So there's that as well. Like, you know, somebody gave me some really, really good advice early on in owning my business, and it was hustle. Don't worry about it. Don't worry if you're still working on home-based equipment and you're making a commercial product. You know, don't worry if you have to, you know, run this business making $100 at a time. And I think like me going into small business, thinking to myself, oh my gosh, this is going to be fantastic. I'm going to sell this amazing product and everyone's going to love it and I'm going to make a bunch of money. And I think, you know, of course I'm exaggerating, but like, oh man, we have grown this business farmers market by farmers market by farmers market. And product, you know, and then signing on with a distributor. Like, I feel like the wholesale conversation is a really, really good one, but I feel like I could not have sat at the tables of our wholesalers talking to them or the tables of our distributors and talking to them about the impact of our product without knowing the impact of our product, without having, you know, talked to individuals, shook hands, you know, have people come back, have people write us emails, like individual people. And that happened at the grind of farmers markets, failing, getting up, failing, succeeding, getting up, failing, you know? And so that's my encouragement. Again, I'm on this call because I know very little about financial. My mom is my amazing, most wonderful accountant. But I need to learn more about how money impacts my business because I feel like I'm in a perpetual state of not having money. But I can weigh in on that question. And it really is, for me, it's just been a hustle and a grind. So that's what I wanted to share.
Thank you for sharing, Becca. I really appreciate hearing your story. And I think a lot of people can probably relate to you in that sense. Like one of the great things about companies like Naturally Austin, like there's nonprofits out there, right, where you can go and find a support group of people who are in it with you and also, you know, going through the same things. Branchfood is such a beautiful example, right? Like this is your network of people who can be your resource because they're going through exactly what you're going through and they'll be there with you every step of the way and you'll grow together, which is the great part. So, but I can speak to a lot of brands that are still small, but have been like on Instagram, on Facebook, like really hustling and trying to like build that marketing strategy around their brands to make sure that they're growing and that they're getting out there in front of people, and that they're letting them know where they can buy it, which more often than not is those farmers markets or directly on their website. Direct to consumer business, like them buying through your website is going to be one of the big ways to grow it initially.
Yep.
Dave,
and also too, can I plug for the monthly meetings that Branchfood has, the community town halls? If you're not already on those, that's a really good way to kind of air some of like, I mean, I guess concerns about your business too. That's a really good platform to do it as far as what you're saying about support. So I just wanted to weigh in on that too.
Thank you, Becca. We appreciate the kind words. And we're glad to hear that our community tables are helpful to the community of founders out there. We'll make sure to include information about them to the attendees in the follow-up email. Thank you.
Any other questions? I think at this point, probably most helpful to just have an open Q&A. And we've got, again, we'll send this out as a follow-up. There's some slides in the appendix that are more specific to how you finance your business, which I think, Irene, to your point, may be more relevant for those who are out or considering a bigger tranche of outside capital. And you know, feel free to flip through these and ping us if you have any questions as you do. But rather than going through that, I think it's probably, frankly, more interesting to all of us and more helpful just have open Q&A. And Irene, I think on your wholesale question, I mean, the challenges of getting awareness in wholesale, farmers markets, distributors, door by door, so different than those who have a direct to consumer first focus as well. And so we see both. And it's such a different conversation. And I started to flip to one of the earlier slides around sort of your revenue and profitability, those lines. Often particularly with direct to consumer businesses, we see some really huge marketing, spend to grow that awareness. And so in those early days, as you're building revenue, you're spending more and more and more and more. So it can just be really capital intensive versus the farmers market wholesale approach, which particularly if you're doing this yourself is and trying to get to sort of cash flow break even as quickly as possible. It's all about hustle and getting in front of people. It's not about the sort of Facebook or Instagram spend.
I love this question from Joshua at Lisa. It says, what if your books are a mess, like no tax returns in years? I will say I've seen it. Like I have 100% seen it where it's been a couple of years and we're getting a set of financials and it is a hot mess. What I would recommend is find a finance and accounting partner who can help you clean it up. Once they clean it up, then you can feel confident in what your numbers are and what your metrics are and start taking those to investors to get the fundraising you need to continue growing your brand. So
tell your friend, Joshua. It's a great question.
and it looks like Becca has a question.
I might have lost you, Becca.
Feels like we just never have money. And I know that that's just small business life, owning your own.
Becca, I think we lost you.
If you can hear us, maybe just drop your question into the chat box and we can do it that way.
Exactly.
So Michael, you're asking, can you give some directions on where to find multiples for valuation analysis? There's no great answer, right? I mean, at the end of the day, somebody's going to pay, it's sort of what the market wants to pay, right? But there are a handful of banks that publish public market comps, so valuation multiples of revenue or earnings if you have it by industry. So that's a potential resource. Some of the sort of mid-market banks in particular might be more relevant. There's a handful of newsletters. For private company valuation, it's really hard because most of the time those are not disclosed. I will tell you for CPG businesses, often sort of that combination of wholesale and direct to consumer, sort of a wide range, but I'll give you a starting point, which is we often see somewhere between 1.5 to call it 3.5 times revenue is kind of the range. But there's a huge bell curve. I mentioned there's some industries like some of the plant-based or protein alternatives. You can just see things that are off the charts. Some of the alcoholic sort of alcohol comps have been kind of crazy. So we'll see like 10x revenues for some of those if there's a path to getting acquired down the road by one of the strategics. So super wide range. So not a great answer, I know, but ping me afterwards. I can point you in the right direction of a couple of comps if you're getting close to needing that info. What did I miss? Yeah, metrics, KPIs that are valuable. I think we can go back to the slide earlier, which I think is relevant. Let me find it again. I think in wholesale, often things like velocities and kind of basically how you're doing in each of your distribution points and how that changes over time, right? That's what they want to, that's one key indicator of the success and the value of the brand and the product that you have. So velocities tend to be really important. Obviously, at a high level, revenue and gross margin, like we talked about. Jump in for anybody else who's been, I don't know if anybody in the group has financed the business recently, but anything that came up. I mentioned earlier on any sort of direct to consumer or subscription business, repeat purchase, and sort of getting to a lifetime value of a customer sort of thing. Those tend to be really important drivers of value.
Yeah, I will say gross margin is our favorite metric. Every single time. I've heard it referred to as the financial IQ of the business, the health score, the temperature check. There's a ton of different words for it, but at the end of the day, it's certainly the most important. And there's a couple different ways that you can riff off of it, right? Which is as you start launching products, as you start going into multiple wholesalers, looking at your gross margin by product, looking at your gross margin by distributor or customer. And that'll help you see like where you're getting a return for your money. And I say return for your money because more than likely when you're going into wholesale, right, that's when you start having trade spending, you're launching promotions, and that's going to start to really affect your gross margin. So that's where, you know, that gross margin becomes very important to make sure that you're selling the right products into the right stores.
There's a question around making the jump from farmers market to grocery retail and sort of financing and other options for that. That's probably a good one to open up, Carol, to the broader group, because I'm sure somebody has firsthand experience with this, whether that's through Kiva or other microloan or others. I think a lot of the, some of the wholesale partners themselves have lending facilities. They tend to be smaller, but I don't know if there's anybody in the group that has some experience that they want to talk through. Crystal, anything you've seen with our early stage clients? I mean, what I see in terms of the dollars required to really get to a bigger footprint on wholesale, it tends to require friends and family or angel. It's just more than a microloan. And so again, that sort of gets you very quickly into a different path where you're going to need to figure out, hey, if I do get you know, regional distribution in a Whole Foods or something, how do I execute against that? And so it's sort of a different conversation than so it's kind of the bigger, faster. That's what we see more frequently. I don't know if there's anybody else who wants to chime in with anything you've seen, Crystal?
No, the only thing I might recommend in addition, before you go, let's say wholesale nationally, is think about which local grocery stores are big in your city or in your state. I live in Austin, Texas, so H-E-B is a huge grocery store in the state. So that's one where, you know, before you go to that Whole Foods or maybe before you go through Albertsons nationally, you're making the leap to them before those others. It's usually a little bit easier to get in the door because they'll feature you as like a local, or like for instance, in Texas, H-E-B calls them, I think, look, you get like loco promo, something like that. I forgot what it's called, Loco Coco or something like that, but Combo Loco, where they're helping early stage brands that haven't received a lot of traction nationally. So I definitely encourage, again, meeting with those few distributors that are local.
Yeah, and John asked the question around basically the form of agreement if you're getting investment money from friends and family or angels. What I see most typically for that first friends and family round is either a SAFE, which is a simple agreement for equity. So that stands for or a convertible note, they kind of are, they're similar in that you're not actually putting a value on the company. If somebody gives you, $200,000 of an investment in the business, you're basically saying, okay, for your $200,000 at some future date, this is going to convert into equity in the business. And there's some different permutations of what that looks like. So there's a slide in the appendix that you'll see, John, that talks about that a little bit, but you can also find template forms so safes were developed by Y Combinator a few years ago, and I think one of the law firms that they work with, and they have those forms are available. I think there's 4 or 5 different permutations on the Y Combinator website. So we can find the link and send it as a follow-up if you can't find it easily. But again, philosophically, keep it simple in the early days. Just make it easy.
We are at time. I do want to give Becca the chance to ask her question before we jump off. Becca, if you're still here, please, by all means, you can unmute yourself and ask a question.
Can you guys hear me?
We can.
Okay, I'll make this really short. Why does it feel like my business is never making money? So we do well at these markets. We do well at wholesale. We're doing well at distribution. And everything we make is going back to the business. And I recently got a question like, why aren't you taking home money yet? And is the next step to hire a financial advisor? Where do we start? How do we restructure so that I can eventually do this full time? That's my goal.
Yeah, so so before you hire anybody, it's worth just having a conversation. And so if you ask me that question, my first question back to you would be, let me see your financials. And I'd probably go through a handful of things that we touched on a little bit here, but I'd want to know, what are your margins? What are your product margins? What else are you spending in order to sort of deliver this product to customers? And then we sort of go through that. And it may be obvious very quickly, it may not be, and it may be a series of conversations, but that's where I would start. I don't know, Crystal, yeah.
No, I think.
Great, thank you so much. I do want the business to be.
Oh, yeah, Becca, I don't know if this will make you feel better, but what I will say is most of our clients, they don't have a net profit for a long time. They're bringing in sales, they're making sure that they're hitting gross margin targets, but it takes a while to get to where you have a net profit. And that's why the fundraising is so vital for startups.
Profitable, so great. Thank you guys so much. Super insightful.
So do pay yourself at some point, please. Even if it's a massage.
Yeah.
Self-care is important.
Agreed.
Dave and Crystal, any last thoughts before we wrap up this session?
I thank you all for the opportunity, and we'll follow up with the slides and ways to reach us as well as the broader team, and would welcome the opportunity to continue the conversation.
Well, thank you to the both of you for this very lively and insightful session. Thank you for taking the time to share your insights with our community. We will share the recording and the presentation slides in an email tomorrow morning. And if you have any questions, you can reach out to Crystal or David, or you can reach out to Branchfood at info@branchfood.com. Stay safe, everyone, and enjoy the rest of your day. And thanks again, Dave and Crystal and the entire Propeller team.
Thanks, everyone. Thanks, Carol.
Have a good one, y'all.
Take care.